Investors Chronicle.
Welcome all to the Investors Chronicle Companies and Markets show, coming to you as usual from the studio at FT Towers. We record this week on Thursday, the 26th of September, and we'll start with Smiths Group, the FTSE 100 engineering conglomerate that has a new chief exec and which reported full-year figures on Monday. Mike Fahy is here to discuss. Then we will chat about some of the issues that have bedeviled UK markets in recent months, or in some cases much longer than that. Alex Hamer will ask what can be done to improve UK pensions for both scheme members and perhaps for the nation as a whole, while Mike will examine ways to improve the UK small cap market. Notwithstanding, or perhaps even because of the doom and gloom, takeover approaches and rumoured deals for UK companies have continued, not least over the past week, albeit there are signs boards are getting tougher and increasingly holding out for better offers. Advanced Medical Solutions and Rightmove are two of the companies we'll be chatting about with Jennifer Johnson later on in the show. Smiths Group, though, to begin. Mike, you looked at these figures the other day. Let's start with an overview, and perhaps an overview of what the company does, because there are a lot of moving parts there.
Yeah, it's one of the last big industrial conglomerates, really, on the UK market. It's got four main divisions. The biggest is John Crane, which makes a lot of seals used in the oil and gas industry. That's about 36% of its revenue. Perhaps the best known division, though, is Smiths Detection, which most people will maybe have seen the name when wandering through an airport lounge, having just shoved their bag through the security check. It does the big scanning equipment, and it does some of the more high-tech equipment. When I flew to Ireland last week, I always love coming back through Shannon Airport because you don't have to take anything out. They just shove the entire thing through the Smiths machine there. And I noticed they had the same machines in Stansted when I was going through as well. But that is a very profitable part of the business as well. The other bits, there's a company called Flex Tech, which makes a lot of pipes and hoses used in general industrial. And then a division called Interconnect that sells lots of electronic kit, cables, connectors, that kind of thing. The results themselves, they weren't too bad, I didn't think. When you look at their long-run targets, they hit most of the shares. The like-for-like revenue grew by about 5.4%, and it has a long-run target of between 4 and 6. The headline EPS grew by 8%, and again, the long-run target of 7 to 10. The big disappointment really seemed to be with the adjusted operating profit, which came in about 16.8%, which was below its 5-year average of between 18 and 20. But the shares fell. They were down 8% at first. They eventually trimmed back to a loss of 5%. But that did seem quite a hefty discount considering what looked like a reasonable set of results.
I'm tempted to discuss the airport scanners a bit more, because it sounds like they're making good machines if you don't have to take anything out, which, let's face it, that's what we all would ideally like to do. Yeah, but we'll stick with the results. I think part of the reason for the initial sell-off seemed to be as well that there will be some full-year downgrades on the back of these minor downgrades maybe. So the near term has got a little bit tougher, but there's, as ever, as you'd hope, there are some more positive signs in the medium term. There's a new chief exec in place, as I said at the top as well.
Yeah.
I say new, he's been in the company for decades, I think.
30 years, over 30, 3 decades, they say.
Yeah. But he's got a couple of things he's planning on doing.
Yeah, and he led the detection business we just mentioned as well before taking over the top job. He announced a strategy update and an acceleration plan. And I think some people looking at Smiths externally look at this conglomerate structure and think, well, is that the optimum valuation? Whether or not this is something that could be ripe for a breakup. So when someone new comes in, there's always, the idea that they will look at this as a whole and decide whether or not some of the parts could be offloaded. But with him being an insider, it seems that the strategy that he came up with was very much based around keeping it as a common whole. He's talking about the businesses being independent but sharing common characteristics and manufacturing knowledge and aftermarket service and the same automation and materials expertise. He also talked about the positivity of some of the end markets it's in, like safety and security and productivity, etc., and that there were kind of potential for long-term appreciation right across the board. But in terms of what he wants to do, some of it is to move into adjacent markets to where they are. So with John Crane, for instance, that could just be different types of seals and different applications. With Smith's detection, it could be other types of threats, detected machines, detecting other types of threats. For the acceleration plan, he was talking about making 30 to 35 million of potential annualized savings. A quarter of those would come not next year, but in its 2026 financial year, and the rest by the 2027 year. How they're going to do that? It's same as a lot of companies, really. Simplifying structures, rationalising property, cutting the number of sites. I suppose when you look at 30 to 35 million of potential savings, they're going to spend 60 to 65 million on this, they said. Half next year, half in the 2026 financial year. And on top of that, another 10 million of CapEx.
They are still going to acquire more businesses, though, as well. You would assume that is a core part of what they do. Despite the simplification, they're going to be bolting on at the same time.
Yeah.
How do we sort of see that balance, I suppose, between all these things? Because there's been a buyback going on. They've said the second part hasn't begun yet.
No.
Albeit doesn't seem to be a particular reason why it hasn't begun. There seem to be an okay position financially. But equally, there's that CapEx, there's the cost savings, there's more deals they want to do. Is it tough not only to get a sense of what the company does, but also how it prioritises different spending opportunities at the moment?
Well, so if you look at the capital allocation, it's very similar to a lot of companies, really. They talk about organic growth being the main opportunity and investment in R&D through that. And obviously, there's some spend attached to the acceleration plan. For the next year, they're actually warning that cash flow would be a little bit lower because they're spending up to 110 million in CapEx, including, I think a big chunk of that is in John Crane, and it's aimed at automating some of the processes to drive that margin higher to the midterm target. Obviously, organic growth is the prime. Then they look at M&A, and then if they can't find anything more suitable to spend the money on, then they go to buybacks and dividends.
The valuation, there was that drop initially on results publication that closed up a little bit by the end of the day and closed up a little bit further in the days that followed.
Yeah.
But can we talk a bit about that? Because we have changed our rating on them as well in the opposite direction, perhaps.
It's all kind of viewpoint dependent, isn't it? But they were on a buy, but they were trading kind of in line with where they were. And they trade at a slight discount now, like 15 times earnings compared to the 5-year average of 17 times. So it didn't seem like a massive screaming bargain in terms of an opportunity. You mentioned the short-term downgrades. So that then probably brings us somewhere in line with the long-run average. And then there's going to be some disruption with the acceleration plan, with the optimization of sites and slightly higher spending that they mentioned. So I just didn't see a strong buy case in it anymore.
Yeah, one of those classic cases where the PE looks attractive for now, but then you see when the earnings downgrades come through, even if they're only relatively small, that attraction moves away mathematically, as it were. Well, Smith's, we touched on the new chief exec briefly. There's not a huge amount there because he has been with the business for so long. This probably takes us on to our next segment, though, because the previous chief exec left for a company half the size in the US where he'd nonetheless get paid a lot more. And clearly the attractions of the US market have been source of much angst for UK investors this year, the sight of companies moving over there, etc. However, there are other pieces to this puzzle, and that's what we are looking at this week. Pensions in particular, Alex. The backdrop here, we'll talk about the context, but so the headline context for me is really the big drop in UK pension funds allocation to UK shares over the past 20, 30 years now has really fallen very significantly, and it's very low now by international standards too. There are a lot of moving parts to this discussion though as well, so why don't you talk about what your thinking was with this cover feature this week.
Very nice segue, by the way. I feel
Thank
like
you.
we're all riding one of those two-wheeled scooters. Yeah, I think I came to this this topic, through having had a super fund in Australia and then moving over to the UK system, which is a lot more opaque, particularly from a defined contribution, workplace pension point of view. And I had a bit of time earlier this year on a sabbatical to look into that a bit further. And, I kind of sat on that for a little while and have put it together for this cover feature. But what the broader picture that comes through with this pension system is that it doesn't really work for that many people. We think about how much people have in their DC pots. You think about the returns that the closed defined benefit schemes have. I mean, they basically just need enough to keep paying people out. So that's why that system has developed the way it has.
Yeah.
And then you've also got things like the public service open DB scheme, which basically just has £1 trillion sitting there doing nothing. Part of that picture, especially for us at Investors Chronicle, is that really low exposure to domestic equities. And I think there's to split that into two parts. There's the question of where the workplace pension cash is being put, because those are the open schemes that have a growing set of assets because people are still paying into them, and contributions have gone up since 2019. So that cash pile is increasing. And in those most DC funds, there is a bit of equity exposure, but because they have international strategies, there's still quite low investment in the local stock market. And there's been a few reports out this year that really focus on that. And so it comes alongside this discussion about the London Stock Exchange being, on a downward path in terms of companies listed, in terms of their performance, and just in terms of reduced investment overall, which kind of has been a major theme this year. So to put some numbers on it, after waffling for a while, New Financial, which is a think tank, puts the overall pensions exposure to UK equities at about 4%. Australia, for example, the overall exposure is close to 30%. And there's some peculiarities with the Australian system that I think make it a good example for particularly the DC space, where it is only about 30 years old. So the superannuation fund system, it's basically been building since the mid 80s, but then it fully came in 92, and coincided with a ramp up in the local market. So it was this virtuous circle that really made local investment a really positive feature of those super funds, and therefore it's spun into, I think it's the fourth largest set of pension savings in the world per capita, wildly ahead of anyone else. So there's a few lessons in there on how, we're still in this transition phase between DB schemes and DC schemes. So what can be done now to kind of get some of those returns on the local market? I said about 500 things in there, but hopefully you can pick out something to go on.
Well, it's a knotty topic, isn't it? We can, to an extent, put aside, as you have done, the DB pensions, because the reason they've de-risked and the liability matching and what have you is a whole other debate, but one where it's probably harder to put the lid back on that kind of worms at this stage. They are pretty mature schemes, but there is that DC opportunity. There is the public sector pensions, which we'll come to in a minute, and some of the potential for change there. But we should also talk about maybe the way that UK pensions are invested a bit more, DC schemes, because it's not working for the country, but also in some cases not working for members, as you've said, both in terms of people who don't have too much in there, which is clearly partly a cost of living issue, but also perhaps in the way some of these pensions are set up. And you spoke to at least one person who was quite critical of the lifestyling strategy, which a lot of UK default funds use. Can we say a bit more about that and what they propose as an alternative.
Yeah, I'm going to give you another two-part answer because
You're in the weeds of the whole thing.
I'm in the weeds. Yeah, pull me out, please. But the first part of it is you take a new job. The trustees who are looking after you and have picked a scheme for you within that company. They've probably chosen a neutral or a lower risk portfolio product from that pension provider. And what you can do, it basically works for people of any age. You can ask to be put in a higher risk, more equities exposed option, and that will hopefully generate some higher returns. I mean, there are, markets move. So the point is the risks are higher, but with compounding over hopefully 10 to 30 years, you'll really feel those returns. And the second part, lifestyle, as you talk about, and Chris Mahan, he has written a report for the Policy Exchange. He's a fund manager who worked in Australia, but he's been in the industry here for most of his career. He pointed to people being shifted into lower risk products or assets the closer they get to retirement. So basically, the funds are trying to protect your pile of cash the closer you get to retirement by moving that away. And in some circumstances, that might mean, the retirement age that you've got on your pension is maybe 67, and from the age of 40, you're gradually being shifted across to bonds and even cash so that pile is maintained. And to think of that
erosion
of growth is, it's massive.
Yeah. There's a big potential upside that's being sacrificed in order to ensure you have the same amount at 67 as you do at 40 to an extent. Is not quite that simple.
Yeah. And I think the funds actually give you a choice quite early on whether you want to go down that path. So there are ways to avoid it. It's just largely around being aware that that's happening. And there's things where you can push out, you can change your retirement age within your plan as well, so that you get to lifestyling later. So, I mean, the underlining factor is being aware of how all this stuff works. And I assume most of our listeners have a good idea, and this might even be irrelevant because they run SIPs. That's the view of our readership. But in broader society, I mean, this is such a low priority for a lot of people. And I think that accessibility side of things on the personal finance level is really important as well. And the government and the FCA is aware of that, and they're trying to push things which also very common in Australia, like league tables, where you look at your pension fund's performance or your exact product's performance. They want to bring in a traffic light system. So if a fund is expensive, poor performance, and actually has service levels that people don't like, it might be stuck with a red. So if you see that on the product that you're already in, you might move. So that's in the works as well. That's out for consultation. So there's all these little things that should help people, manage that. And at the same time, what that does is push cash into higher risk products. And then you come back to the allocation conversation of where managers are putting that cash. And I think, there's a long-term pensions expert who, while I was doing this, I saw he was questioning the idea that this cash must go into UK equities. But I think there is a good argument for this money doing good in a more general way as well. And it's not donating to charity, but in a way that you can boost local companies, local valuations. It comes into that virtuous circle that I was talking about.
A couple of other things I wanted to talk about. Firstly, in relation to Australia, I suppose, but in the broader context, is the two of the big differences in the Australian system, as we touched on. One is the employer contributions are much higher. As with increasing employee contributions, it's easier said than done. But I think they're going up to 12% as a minimum this year, next year, aren't they? Whereas the UK is 3% currently. So there's a big difference in assets there. And the other thing is they have, as the name suggests, super funds, so much larger pools of assets to invest, which enables you to take more risks and invest in less liquid strategies as the government is starting to try and make some moves in that direction here as well. There'll be a big question about, say, I think as you say in the piece, local government pension schemes and what they do with those pools of capital and how they invest and whether this money will be to something productive for both members and the country in general. But the 2 points you make at the end are quite interesting they're quite radical suggestions. One on public sector pensions and moving them to a funded model so that you have a much bigger pool of capital there. And then also I think it was the Tony Blair Institute suggested, conversely, for private sector pensions, moving them off the balance sheet of companies, which would potentially allow them to take a bit more risk rather than just move to this kind of DB safety first model. Can we talk a bit about the public sector? I mean, this seems highly improbable. No government would ever really want to put this on the balance sheet, but it's quite an interesting idea.
Yeah. So this idea comes from Toby Nangle, who's a frequent FT contributor, but he put this down for New Financial earlier in the year. And, we talk about closed DB systems and open DC schemes. And the monolith in the middle of the sector is the civil services open DB scheme. And it seems like, you go and work for the public service and where my wife's employed, and it took a long way into the the interview process and kind of where they even mentioned that it was a DB employer, and so they talk about a 28% pension contribution, which is meaningless when you've got a DB set up, and it just seems like everyone's trying to keep a lid on it. Like, let's not talk about this too much because eventually they'll take it away from us. But Toby's idea, to go back to that, was the idea that this cash is just sitting there because it's basically, pay in, pay out, and they maintain it in a sustainable way through doing that. Bringing it onto the government balance sheet. So effectively what happened with the accounting changes just over 20 years ago that put pension liabilities onto corporate balance sheets, which we'll talk about in a second. Doing that, because it's the government balance sheet, it's obviously the headline figures are important and people care about the books being within cooey of, they don't need to be balanced. It's not a household, but you know what I mean? That would allow that cash to be used, and I think Toby specifically talks about, so increase the stock of savings, deepen pools of capital that can be drawn on to enhance the capital stock, boost economic growth, and help finance the transition to net zero, among other things. And that sounds pretty good. I think it's just such an ugly proposition for any government
to suddenly say this, we're adding this to exactly the debt pile.
And then the opposite for Tony Blair Institute idea was that to reverse the corporate DB scheme, highly restricted, flight to safety or highly restricted options, because you just don't want to be in deficit. And, you talk about companies like BA, BT, the kind of classic, huge, sometimes formerly state-run companies that are just sitting with these decades of pension liabilities. And then that's also, hundreds of billions of pounds sitting in fixed income, which is, I don't think that's going to change.
Yeah.
But that's also why, for example, the overall exposure to equities is so low. And this is just a way to try and get around that.
Yeah. Well, we could talk about this for the entire show, but we're not going to. So we're going to talk very briefly about the small cap side of things now, Mike, because you've written about that this week as well. Clearly, it's linked partly to do with the outflows from UK equities in general, albeit in recent weeks for a number of reasons. We've seen more positive signs. I want to talk maybe about, in the limited time we have, let's maybe take the example of a company you looked at in the piece and the balance being struck between credibility, if you will, and liquidity, because there's always a lot of questions about liquidity nowadays and how liquid is the market with these outflows.
Yep.
But there's also a question of how to get professional investors interested in your company. And you had a good example of a business that's tried to straddle those two things.
Yeah, so if you are struggling to attract funds from institutional investors. There's the knock-on effect then of nobody really being willing to underwrite placings. Then if you can't raise money on public markets, what is the point of being on them? Which is why we've seen, I think, quite a number of the delistings that we have this year. If you go through the statements, they all talk about liquidity. But yeah, you mentioned hVivo, because I think one of the interesting things about them, and speaking to its chief exec Mo Khan, was that Mo was from private equity background previously, and he's run similar companies privately. And that's also one of the reasons why we're in the situation we are, because there's so much more private money. But you get the impression that he would actually maybe prefer that the business of convincing funds to invest at the small cap market is incredibly difficult. But he also talked about why it was so important, partly for that money raising aspect, and the amount of time you've got to put into to do it, to get it right. It's one thing to be a small company and complain about the lack of interest in your shares, but if you were continually posting results that are disappointing, convincing anybody to invest is going to be difficult. So he talks about the importance of getting out there, of trying to convince analysts to cover the stock and trying to convince institutions to invest. And the way you do that is partly through performance. The way you do that is also partly through making yourself available, and that's both to institutional and to retail shareholders as well.
Yeah, and there's a question here. There's separate questions, which we probably won't get to today, but I'm sure we will in future, because there's a lot of discussion about them of, well, A, what will happen to the AIM market? hVivo is part of the AIM market. There's some discussion about that in the budget potentially coming up in terms of reliefs, but there's also in the piece some suggestions of going the other way and how you can actually do more to support it and support its role in the UK economy. And likewise with the subject we alluded to earlier, i.e. the question of whether there will be more mandates in terms of investing, making people invest more in UK assets, which obviously is quite a controversial topic. There is already this 5%, this pension fund.
Mansion House Compact.
Exactly, which does have an application for small companies as well.
Yeah, so it is under the compact. Pension funds, or 11 of the biggest pension funds, have committed to invest up to 5% of DC schemes in unlisted equities. Unlisted equities also includes, the definition also includes AIM and Aquis shares. And I think the difficulty, or some of the complaints so far, has been that there's very little evidence of them doing that. Now, if you speak to, as we have done previously, the ABI, which is sort of looking at this from the pensions point of view, they will say it takes time to set up some of these vehicles to invest. I think they put out figures last month which said so far that 5%, we were only at 0.36%. Charles Hall at Peel Hunt was talking about maybe setting a minimum level of mandation towards AIM and Aquis as a way of improving those flows. So if you are pension funds, if you're serious about investing in unlisted, in risky equities, then kind of prove it really by putting in that minimum benchmark.
Yeah. The one thing I wanted to say, actually, I forgot about hVivo as well, was the trade-off between liquidity and institutions, because you need to get them on the shareholder register that can encourage others, but then you get these big people holding a load of shares and you actually reduce the liquidity in doing so. So there's always a bit of a balance, but there's more of that in the piece, in both these pieces, which are online and in print this week. Let's talk about some takeovers, though, or potential takeovers or takeover rumours. In the last 10 days, there have been a few. Why don't we actually start, Jen, with Rightmove, because that is where there is some concrete interest from Australia. We were talking about this. It's back to Australia again, from some of the Murdoch family, one of the sons of Rupert Murdoch. So, you can make your own succession comparisons. But they have been trying to buy Rightmove with, so far, extremely little joy. They've been making several approaches, all of which have been rejected.
Yes, so there have now been 3 offers and 3 rejections. I guess the question now really is, does this mean that there's no chance of the deal getting over the line? And I have to say it's not looking particularly promising. at the moment for kind of a number of reasons. One, Rightmove's board hasn't been willing to engage as yet, which is never really a kind of positive sign. It's not an indication of interest. So it means that the bidders, REA Group, will need to come in with a genuinely serious offer now, and there's not much time left. Here in the UK, we have something called these put up or shut up rules, which means a potential bidder has 28 days to come up with a firm offer after it initially comes forward with a bid. So within this 28-day window, there is likely to be an almost auction-style back and forth involving several bids and several rejections. REA says its latest offer is 770p a share, but Rightmove has come back and said that the implied value of the offer has actually fallen to 761p after falls in the REA share price. Rightmove, it's fair to say, has been hurt by higher interest rates, a slower property market, and so it's seen as being in a trough. And a big cash offer, which would have been above the all-time high, would have been harder for Rightmove's board to ignore. So it's really this kind of classic story at the moment where a UK company is seen as being worth not a lot. There's this kind of perception of the UK market as a bit of a bargain basement. Companies are trading at substantial discounts to their global rivals. And so when bidders come in with what looks like a decent offer in terms of current share price premiums, boards are still unimpressed. Boards could be of the opinion that these present valuations aren't a reflection of the company's inherent worth. And so these lowball offers won't appeal unless, for whatever reason, the company and its major shareholders are kind of very eager for a sale. Rightmove as kind of one of the sort of jewels of the FTSE 100. You can see that there's significant motivation not to sell there at the moment.
Yeah, it's always a company where there's some news flow. We had the US company buying, was it On the Market or someone earlier this year, trying to be the latest people to try and disturb Rightmove's dominance in the UK property market, but that's a long way out at the moment. And yes, this deal, the fact that it's being pitched as cash and shares, and REA Group shareholders clearly aren't too positive on it, means that therefore the value of the deal falls as these offers are announced. It does seem in general there's been a bit more reticence from boards over the last few weeks and months. I mean, maybe it's just coincidence, but there's also the example of TI Fluid Systems in recent weeks as well, which has been reticent to accept an offer. Maybe it was the case earlier this year, where there was a sense perhaps the boards were caving in too quickly, and perhaps now the UK market has got a bit more, it's a decent year returns-wise. There are some green shoots. There are lots of analysts who are increasingly pointing to the market as a sign of value in general. Perhaps it's a case, not just on a case-by-case basis, where boards think, no, our company is worth more, but they also think the mood music is changing a bit as well. It's interesting too, you talk about the engagement. There doesn't seem to be as many hostile moves as there once were. They're always quite rare, but nowadays they seem to be almost extinct. So we'll see what happens with REA. But the other one to talk about from a shareholder perspective is quite interesting too, is Advanced Medical Solutions, because this is a case where it's a reminder, I think, isn't it, that deal speculation doesn't always materialize, because we've been so used to a lot of these deals coming through and a lot of announcements. But this was a Sky News suggestion that someone was looking at them, but at the moment, it seems like nothing is actually happening with AMS.
Yes. So what happened was the kind of evening before the release of the interim results last week, there was this Sky News report that said a private equity firm is studying a takeover bid for the company, which is very kind of wishy-washy, really. It's not prepping a bid. It's not, like preparing to launch it. There's none of this kind of, it's studying it. It kind of suggests there's not momentum there yet. Nonetheless, sent the shares up about 10% on the morning of the interim results last week. But given the company never confirmed an approach, which is kind of the way that proceedings work, a company that has been approached will come out and say this has happened. That didn't happen in this case, though. And though it was also reported that Advanced Medical Solutions has other potential suitors, anyone who bought the shares on deal speculation has definitely been burned at this point. I believe that the company is kind of down something like 8% in the past 5 days. So the speculation and the share price boost were very short-lived, which is definitely a cautionary tale for investors. Just because a company has takeover interest kind of bubbling under the surface does not mean that it's going to get acquired at a massive premium. There are plenty of things that can go wrong.
Yeah, the fairly underwhelming results from AMS probably didn't help as well.
No.
Certainly with that lack of, I mean, in fairness to Sky News, and they have a very experienced M&A team there, but you do have to be careful writing these things, and sometimes it's a case of knowing that discussions have taken place, but you're not sure whether no one's quite sure whether they're still live, and the fact there was no statement from AMS suggests that the discussions are not live, according to, if everyone's sticking to the letter of the law with takeover rules. Yeah, there's not much happening there for now. Yes, it can be tricky to thread that needle, I think, sometimes from a journalist point of view, which is not really what anyone cares about, but I do. Why don't we finish by having a little discussion of AMS itself, because you've covered the company for a while now.
Yes.
As I said, the results were a little bit underwhelming. What did we see in those interims the other week?
Well, I guess I would say if you're the company that was looking to acquire AMS, there are reasons to like it. So it's in this kind of defensive space, wound care products, i.e. glues and sutures, which are hugely important in surgical care. So demand is not terribly cyclical. Medtech companies tend to fall into kind of either one or two camps. They're startups with a handful of unique technologies, or they're giants of the industry like Johnson & Johnson. And Advanced Medical does not fall into either of those particularly, because it's a cash generative company. It is coming out of a period of restructuring and review of its portfolio. I think part of the business that was expected to outperform underperformed. So there was a little bit of a kind of shock there in the wound care division. But it recently closed an acquisition of a smaller rival. So I think there's kind of clearly a case for the board of AMS wanting to see these developments through before kind of considering any potential offers. And I think that case also applies for shareholders.
Yeah, that makes sense. Well, it's an interesting company. Rightmove, as you say, also clearly a very prominent, a very successful UK company, and one that's clearly used its platform to grow and grow. And we will see what happens with these deals, or would-be deals, or potentially no deals. But there are positive signs for the UK, and hopefully some of the reforms we're talking about can contribute to that end as well. That, though, is the end of today's show. We have reached the conclusion. Thank you very much to Jen, to Alex, to Mike, to our producer, Maddie Apthorpe, and thank you to you for listening. We will see you next time on another Companies and Markets show.